we talked about different ways that you can trade this, and you can buy puts and you can try to buy calls. I'm going to show you something real quick, because this is kind of where you kind of make a little bit of sense trying to trade this stock. Put spread. All right, let's look at Alibaba at 133. Let's say that we sold the January 21st $100 put for 186, and then we bought the 90. Okay, so you're going to get a 71-cent net credit. In this situation, on a put, you have a 93 on this strategy where you're buying the 90 and you're selling the 100. So you're buying that 90 to protect yourself. You're going to get 71 cents in credit. You have a 93% probability of profit, and you're going to generate 7.6% because you're going to put up $1,000 in margin to cover between that $100 put and that $90 put. You'll generate a 46.5% annual trade. Now, that sounds all well and good, but if you're like me, I'm kind of worried that this stock might do what Kenny thinks it might do. This stock could very well fall to 88 bucks. And who knows? We saw what Mark was talking about the other day with that those crazy put options that people were buying. So what if we went the other way? What if we went up the ladder? What if we sold the 165 for the same month, and then we bought the 175? Okay, you're going to get 80 cents back this time. In this case, your max return on risk, you have an 85% probability of profit, and your max return is 8.7%. You're going to generate 52.9% annually on that trade. And again, this is going out to January 21st. That's 60 days. So what I'm showing you is you don't have to just do calls and puts. You don't have to just do, a straight shot downward or a straight shot upward. Because again, let me show you what the probability of profit is in the event that you just bought a put, a straight up put on this stock. And let's say that we were talking about that exact same thing a moment ago, where I said, well, based on this metric of that fundamental, and it was at 16, maybe the stock gets down to 113. Okay. So I'm going to buy a put around 120. That's 5.1, because that's what's going to potentially get me to 113. You have a 22% probability of profit. Your max return, yeah, it's infinite, obviously, if the stock goes to zero. But 22.2% based on what the market is telling you, based on that implied volatility. And that implied volatility rank is extremely high. So this is where people get greedy. This is where people bet, $500, but they don't understand that the odds here are 1 in 5 against them. So this is why we do some of these spreads. This is why we talk about, using less leverage, using less margin, or maybe doing a put spread where you sell one, buy on the other side. Obviously, this is not what Kenny does. Kenny is going to be straight up trading the VWAP on a day-to-day basis. But if I'm looking for something over the longer term, or I have other things going on, or I'm not an active day trader. I mean, all of us are not active day traders. All of us, that is not what we do full time. Kenny makes an incredible living doing this every day for a couple of hours. I'm going to Washington on December 1st. I'm not going to be here. So there's a lot going on. Everybody's got different things. Everybody's going to have different trading styles. In this case, we're focusing on managing your risk, particularly in this insane low momentum, negative momentum market that we're heading into. So there's more to just buying and selling naked puts, naked calls. And instead, Eric's got it. Probability of profit. We want to know what our odds are of winning and what our max return is as well. So